Hey everyone, Brad Gotto here, and welcome back to Retirement Redefined. We're doing things a little bit differently on the podcast today. Instead of our usual format, we're bringing you our most recent market commentary, something that we typically share on video, but this time we're making available right here in our podcast feed. I'm joined by Tim Holland, our Chief Investment Officer, as we walk through what's happening in the markets, what we're paying attention to, and how it could impact your retirement strategy. We're excited to bring you this update in a new format, and I hope it adds even more value to your planning considerations. Let's get into it. Hello, everyone. Welcome back to our monthly market commentary. I'm Brad Gotto, founder and CEO of Fiat Wealth Management, and here with me, as always, is my sidekick, but different this time, not on a different screen, not in Pennsylvania or wherever you are. You're a globetrotter. You're all... And I just happened to catch you flying over Minneapolis. You parachuted down. So you're actually here with me as Mr. Tim Holland, the CIO of Town Square Orion. And so, Tim, as always, thanks so much for taking the time to be here and for stopping in Minneapolis and doing this live with me.
Yeah, no, this is fun. It's good to see you. Good to be in the great state of Minnesota. This screen's a little too close for me. I like my desk because I just look old. But you look fantastic. And
oh yeah, just crushing.
It's always good to be
It's
with
the
you.
lighting and the HD camera. I'm not sure HD's all good.
No, that was a terrible idea. Whoever invented it. No one needs that kind of detail.
Pixelated TVs, you couldn't see wrinkles, right?
No, I'm with you.
How you been? How's the family?
Family's good. Hard to believe it's mid-July. Busy with sports. Grace and Spencer, Grace lacrosse, Spencer rowing, which I think we've talked about some football, which is kicking his butt. 3.5 hours a day, lift and cardio. But they're good. They're good. How about you guys?
Same thing, man. It's the throes of summer. We are on the precipice of our actual summer when baseball starts to wind down and we actually get a little bit of free time. And my oldest is actually not going to play football this year. He chose to stop.
Okay.
Which means all the two-a-days and all that kind of stuff he's missing out on. And so we actually will have a little bit of an end of summer.
Nice.
Which we haven't had in, I don't know, since my kids were shorter than me.
Yeah.
I'll put it that way.
Yeah. No, it goes by quick. It's nice that you're going to get some days back.
Exactly. Very excited. Yeah. But if this is your first ever monthly market commentary, just so that you know, every single month, Tim and I get together and we hit 3 points. The first point is a look back. We take a look back at the previous month. The next point is a look forward, what's coming in the next month that we're paying attention to. And then just kind of for fun, a data point that we think is worth discussing because data in a lot of ways is amazing. You know, as a business owner, I got to watch my data all the time.
Yep.
And it can tell you a lot. It's definitely not gospel or the single source of truth. But that's why we think it's a data point worth discussing, not the gospel, right? Yeah. And so this is kind of the format. Now, that being said, one of the things we are going to change, I would call it an ad, is at the end of every quarter, instead of our look back being a look back at the previous month, we're just going to look back at the entire quarter.
Yeah.
And so a little bit more meat every third month. And so I'm going to dive right in for the sake of time, Tim. And this look back, I am naming the whipsaw.
The whipsaw.
I don't think I have to explain it. I think if your eyes were open at all and your head wasn't buried in the sand for the last 3 months, you will know why we're naming our look back the whipsaw. There's a lot here that we could ruminate on.
Yeah.
I'm just trying to increase my vernacular.
Man, you got some $5 words you're throwing around there. It's pretty good.
Well, they were dollar words, but inflation.
You know? That's good too.
So there's a lot we could talk about. But Tim, what stands out to you the most in this whipsaw that we've had, both economically, policy wise, markets wise, like what stands out?
Yeah, it's sort of like we jammed 12 months worth of news into 3 months, or maybe 24 months worth of news and market movements into 3 months. So it's all the stuff that we all know and sort of have followed. It's the uncertainty around trade, the Liberation Day announcements of April 2nd, what that did to risk assets and investor sentiment.
Do you remember, out of curiosity, how much the markets moved the next day? I don't. I'm actually a little question.
So the number that we came across was the 3rd and the 4th, which would have been Thursday and Friday, that Thursday and Friday in April. $5.8 trillion in equity capitalization went away. It was the worst 2-day stretch in the history of the U.S. stock market. Now the market's bigger than it's ever been, so the dollars are bigger.
Yeah.
Wasn't the worst.
So it's all relative.
Percentage wise, but on a relative basis, on a dollar basis, worst 2 days. And then I believe it was April 9th when Donald Trump came out and announced the 90-day pause on reciprocal tariffs, and the markets took off. And I think the Dow maybe in particular had its best day in 50 years or something.
Yeah.
So once we got a pause on trade.
That's not a whipsaw at all.
No, I mean, that's just, it's, and you could have gone to sleep on Tuesday and woken up, the following Thursday and kind of missed a whole lot of nothing, even though so much happened in those 7 or 8 days. So you got a pause on sort of the worst of reciprocal tariffs, at least relative to what Wall Street thought we were going to get. And then we just came back and kind of focused on fundamentals, and we got some decent jobs reports through the quarter. We got some better than expected inflation prints through the quarter. Q1 earnings came in really strong relative to expectations as we moved through April and into May. And as fate would have it, as luck would have it, the S&P 500 made an all-time high. And as we're sitting here recording this in mid-July, on June 30th, at least in the quarter, and made a new all-time high yesterday. So, I mean, I think the takeaway is it can be hard, but try and take a long-term view of things, work with a financial planner, have a plan, try to be in a position where you don't need to respond to those sorts of market shocks because of the financial situation you've created for yourself. Try and put things in perspective, take that long-term view. But as we sit here, the economy seems okay, profits seem okay, sentiments improved significantly. And even though there are still some trade announcements that are coming out sort of day to day that are a bit unsettling, we think it seems like we're past the worst of that uncertainty. So it's been
knock on wood.
Knock on wood. It was a really interesting 90 days, but we're obviously in a much better place today than we were, call it April 3rd or 4th.
Yeah, sure. I think I say this a lot in this monthly market commentary. I think it's worth saying again. In fact, you and I were just kind of discussing this idea of saying the same things over and over and over again. But it's important to remind people, like, I don't think anybody 90 days ago would have guessed this is where we would be at.
No, all-time highs on the NASDAQ and on the S&P. Low double-digit earnings growth in Q1. Q2 earnings have just gotten going with some of the big banks reporting. Those numbers look a bit better than expected. And inflation hasn't really shot up yet. There's some concerns that the tariffs will drive prices higher. That could still come as we go further through the summer. But, all things being equal, and you have the One Big Beautiful Bill Act signed into law, there's actually, a lot of good news right now after a very, very difficult start to the second quarter.
Yeah. So with that being said, let's shift into kind of this look ahead. And I'm gonna steal one of the tactics of journalists.
Okay.
Now I'm gonna give you a very abrasive headline.
Yeah. All right. Good luck. You're not abrasive. Okay.
The dollar is dead.
Wow.
Tim.
Okay.
Dead. It's over. It's gone. It was a great run. It really was. Most successful economy of all time.
Sorry.
Now it's dead. So you mentioned at the end of our look back over this last quarter, which has been a crazy quarter, net a positive.
Yeah.
Right. You can point at a lot of negative things always, but net on a global level, pretty positive quarter. That being said, because of this bill that you mentioned, the One Big Beautiful Bill, a lot of concern around where the dollar stands. And so we talk a little bit about where it's at today versus where it used to be. In other words, we've had a pullback. Let's talk about that. But then also like trajectory moving forward. We've got a ton of debt. We've got this possibility of adding more debt now because of this bill. Powell doesn't seem to want to take Trump's leading in what he's doing with interest rates. There's just a lot of things that you could point to that people are pointing to and saying, this is it. This is where we kind of lose our footing as the world reserve currency and whether, inflation is going to eat away at it or whatever. So the dollar is dead. Prove me wrong. Or right, I guess. I don't know what side you're going to take.
No, that's you caught me off guard there with the close. So the dollar's off about 10% year to date, as you know, relative to other currencies. So you always have to look at the dollar, relative to something else, right? A stock can go up and down in value relative to its own share price, but it's the dollar versus the UK pound or the Japanese yen. So the dollar's down about 10% year to date. It's been a pretty rough start to the year for the world's reserve currency, which just means more business essentially is done in dollars than in any other piece of paper around the world. And that's been the case for a long time, which accrues all sorts of benefits to the US. So there's been some talk because of policy uncertainty around trade and tariffs, not to get in the politics of it all, but some uncertainty around U.S. policy concerning trade, maybe defense, and how we think about some of our friends around the world, that investors are at the margins moving away from U.S. financial assets, moving away from the U.S. dollar. You put on top of that, the One Big Beautiful Bill Act, by most accounts, will add to the total debt we've accumulated, which is at a record high on an absolute basis and pretty much at a record high relative to GDP. And so to your point, the dollar's dead, or at least its best days are behind it. Any market's really hard to predict, foreign exchange markets in particular. Yeah. So I don't know which way the dollar is going to head. I think the fundamental strengths that the U.S. economy has haven't gone away and won't be going away. And a weak dollar would probably mean a little bit more inflation here at home because prices of imported goods go up and so on and so forth. But if you look at the stock market, which is where I think most of all this work kind of lands us, what we ultimately focus on, our assets and what they might do for us over time. Over the last 30 years, the US dollar's gone up, down, and sideways, meaningful rallies, meaningful pullbacks, and then meaningful periods of just sort of marking time. And over those 30 years, the S&P 500 is up 1,100%. So the dollar's important for sure from a macroeconomic and a domestic economic perspective, but at least as it concerns the stock market, equities have been able to do well regardless of which way the dollar is heading at any particular point in time. And I can't imagine that relationship is going to be upended anytime soon.
So that's a lot of nerdy stuff, Tim. So what I would boil that down to our listeners is you took the positive side.
Yeah.
Just to be clear, I want to know what corner you're in. So you don't think it's dead?
No, it's, we live in a relative world and we just do, right? It's either vanilla or chocolate, right? Or, well, I'm not going to buy ice cream. Okay, I'm going to keep my money.
What you mean by that is with us two sitting here, relatively speaking, you are old.
I am old. I am old
relative to who else is on this show.
Relative to Brad, I'm falling apart.
So we're working out this morning.
We live in a relative world. So it's okay. I'm going to give up on the dollar. Okay, where are you going to go? I'm going to go to Bitcoin. Not big enough, not liquid enough. Yeah. Too volatile. At least not to throw water on sort of the crypto conversation, or I'm going to go to the Japanese yen or the UK. Currencies aren't broad enough, deep enough. We still dominate global foreign exchange transactions. Most central banks hold more dollars than any other piece of paper, at least currency, around the world. So things change, and at some point the dollar may lose its reserve status. But if it does, something has got to slot in. Yeah. And at least as of now, there's nothing that comes close. Not even the euro, in my opinion. So it could happen. I just don't see it happening in my lifetime. I know I'm on the older side, but I'm hoping modern healthcare, I live for a little bit longer. So it could happen. Anything's possible. I just don't know where you go.
Yeah, where else? That is one of the, that is the part of that argument that I feel like people haven't fleshed out. Yeah. When you meet that person that's like, well, yeah, the dollar is dead. It's like, okay, well, the people that are going to leave. Yeah. Where are they going to go?
Where are you going to go? I don't know. There's no easy off ramp.
It's similar to me, and I'm not, okay, I don't want to, well, first of all, you just threw shade at the Bitcoin people, and so I want to be careful there because they're pretty passionate people. Yeah. But equal passion, if not more passionate, are the gold bugs. Mm-hmm. And so I don't want to throw shade at the gold bugs, but I will say this, because again, it's a relative world, and if you're going to leave, where are you going to go? Because you get a lot of people, fear is the ultimate driver, the number one driver of the price of gold when it goes up. Is people get fearful, and we've talked about this in past monthly market commentaries that a couple of times this year we've hit consumer sentiment is negative to the point where we're hitting that 60% mark. Yeah, we've done it a couple of times this year. Yeah, and so gold prices have gone way up. My whole point when people ask me, well, should I buy gold? Yeah. Like, is that a great place? And I'm like, well, kind of, maybe, or especially the physical gold. They're like, well, let's just say hypothetically, it gets to the Armageddon scenario, the markets fall apart, the dollar falls apart. Yeah. What are you going to do with your gold? Yeah. Who wants your gold?
Yeah. Yeah, and no, I think that's a great point. And I don't mean to throw shade at sort of cryptocurrency.
I know, I'm
gold.
just throwing you under
No,
the bus.
I think they're both fascinating topics, especially gold as a store of value, medium of exchange, the history of it all.
Yeah.
But to your point, if the wheels really come off the cart at the risk of being flipped, you've got bigger problems than sort of what do I do with my gold and how do I spend it? And if you go back to the 1930s, FDR essentially confiscated gold. I mean, at the risk of sort of taking on this totalitarian or sort of, big brother mindset, the dollars printed by the U.S. by the Federal Reserve. Federal Reserve works in conjunction with the Treasury. Treasury is obviously part of the U.S. government. The U.S. government is arguably the most powerful institution on the planet, with the most powerful military at its beck and call. So it's not that gold can't go up in value and be a store of value, cryptocurrencies as well, but there's just nothing as broadly distributed, as liquid, as abundant, as easily transacted in my point of view, as the U.S. dollar.
Yeah.
So maybe the system that replaces this is a much more bifurcated system where there is no global reserve currency. There's just lots of smaller players that collectively make up something that looks like a global reserve currency, but there's just nothing, I think, out there that has, again, the breadth, the scale, the wide adoption of the U.S. dollar. They're just not today, and I'd argue not in my lifetime.
What we're not saying is we're not. Yes, there's some headwinds.
Yeah,
but because of where the dollar stands and everything else that you just got done talking about, still the belief being, yes, it's not what it maybe was yesterday.
Yeah,
but it's still the best option.
Yeah,
and you could make the argument buy a long shot, relatively speaking, when it comes to what other paper are you going to buy at this point in time?
I would agree, 100%.
All right, for the sake of time here, the data point we're discussing, this is a little cheeky maybe. I'm calling this net no risk.
Okay.
I like alliteration too, by the way.
Yeah, me too.
And here's what I mean by that. Here's the data point. Non-risk money right now, the 10-year treasury, just kind of the barometer that if we want to use that, which is what most people use. The 10-year government note is around 4.25.
Yep.
Inflation's around 2.3.
Yep.
So we sit at a time right now where you can park your money in a non-risk asset and after inflation, make money and quite frankly, not bad.
No,
a couple percent.
Yeah.
So net, no risk means we, after inflation's factored in, don't need to take any risk to actually have our money move forward.
Yeah.
That's not always true.
No. If you think about coming out of 08 and 09 and the global financial crisis and the Great Recession, and the Fed took rates to the floor, and then quantitative easing.
Yeah. Quantitative easing. There was a buzzword years ago.
Yeah. And bond yields were very low for a very long period of time. And then through the pandemic, the Fed funds rate essentially hit zero. And I think the yield on the U.S. 10-year note hit 0.5%.
Yeah.
So if I think, our country, our government will be around a long time, even with all of its shortcomings. I don't know if I want to loan money to the government for 10 years and get 0.5 percentage point back, right? I don't want to take that trade. But at 4.25, where we are now, to your point, especially relative to the rate of inflation, that sounds like a pretty good bet to me. So if there is an upside, maybe to the pandemic from a financial point of view, the inflation, the Fed cutting rates and then having to raise rates to the point where they did, is this resetting of bond yields and their absolute level and then their relative level as it compares to inflation. And there's been a few studies done that looks at the return of fixed income. And if you look back at kind of where yields were, there's almost a 90% correlation that wherever that bond yield is, that's what you're going to get over the next several years. So if history's any guide, if you buy the U.S. 10-year note, which is, risk-free, the government's not going away even with all of our problems, odds are you're going to earn north of 4% over the next 10 years. And again, relative to the rate of inflation, that's a pretty darn good rate of return, we think.
Yeah, the reason I think that's the data point that's fun to discuss is because when you think about being a retiree, you're not, or nearing retirement, which is a lot of our listeners.
Yeah.
You're at this phase of life where not every dollar you have can sit around and hang out in equities. We all know that like being in the stock market, being in equities long-term, you're going to make more money there than you are in any other asset class that you can be a part of. But if you're trying to distribute your money back to yourself, live off your money, use your money, that kind of stuff, the market's too volatile for short-term, cash flow needs. And so we talk a lot about bucketing money, and the first 10 years of kind of spending and needs and all that kind of stuff have to get wrapped up into something that's not a pure, I like to call them naked equities, just equities with no sort of airbags or guardrails or whatever it may be. And there are times, Tim, there's been times, as you just got done discussing, where if you're nearing or in retirement and you're looking at non-equity positions, there's no meat on the bone.
Yeah, there's nowhere to go. Yeah.
You just have no choice. It's like, if I actually want to make money net of inflation, I have to take astronomical amounts of risk relative to when I want to spend this money. And right now, that's just not the case. And so it's one of those deals. They talk a lot about this with the economy and where it stands relative to our college graduates. And they kind of start tracking you through the system of, okay, if you graduated college in 08, 09, and you came into a horrible economy, what is kind of the trajectory of your work life look like versus walking into an amazing economy? It's true for retirees too.
Yep.
And so if you're nearing or in retirement these days, one of the tailwinds you have is this data point worth discussing: net, no risk. There are opportunities in the no risk space, let alone the low risk space, for you to actually make money. And do it net of inflation, which is really good news. And from a planning perspective, something you should be taking advantage of, because to your point, I can loan my money to the government at 4.25%. And if they choose to lower rates, I still get my 4.25%.
Yeah. And the bonds, if you wanted to sell them as rates come down, should in the secondary market go up in value.
Yeah, you get a premium.
You get a premium.
So there's some good news there. So from a planning perspective, make sure that if you're not, if you're a family that doesn't work with us, that you're at least having conversations with whoever your advisor is about taking advantage of kind of the arbitrage between a non-risk asset and our inflationary pricing. It's a good time to be alive, as they say.
Yeah, no, well said. I agree.
Tim, it's always a pleasure, and actually get to do it in person.
Yeah, this was fun.
Sometimes the last time we did it together was
the lighting. This is fun.
Yeah, the last time we did it in person together, we were in Orlando. Do you remember that?
Yeah.
And I was holding my phone out like this the whole time recording us. You warned me before it started, like, do you really think you're gonna be able to hold that with your arm the whole time? I'm like, I'm fine.
Yeah, you did. Listen, I would have made it 2-3 minutes in. So
we got halfway through it, and I had to like pause and switch hands, and so you were right.
Better than I am.
But the good news is I have 2 arms, so I was able to utilize. Yeah, you guys get the point. So it's a treat to always get to do this with you, and even more so that you get to be here. But I also know you got a flight to catch. So thanks for being here. Thank you. Again, thanks for joining us for this monthly market commentary. We'll be back with you next month. If you have any questions about anything we discussed, feel free to reach out to us at hello@fiatwm.com. Feel free to check out the website. Not only are these monthly market commentaries from past months posted there, but all kinds of other educational content you're going to find there as well. It is our goal here at Fiat to educate those around us and leave them better than we found them through the power of education. And so please lean into the education that we've got for all of you. Enjoy the rest of your day, and we'll see you all next month.
Thank you for listening. Don't forget to click the subscribe button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views and opinions of Fiat Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.